Stocks lower ahead of the closing bell on Wall Street as consumer sentiment hits 7-month low here, which seems to have overshadowed the monthly jobs report. For more on the latest market moves, let's welcome in now Mike Dickson, Horizon Investments Head of Research and Quantitative Strategies, and Vishal Kanduja, Senior Fixed Income Portfolio Manager at Morgan Stanley. Mike, let's start with you. Listen, U.S. economic data, Mike, was obviously front and center today. Jobs report first, maybe. That investors seem to take in stride, Mike. It didn't really seem to shake up the narrative. You kind of looked under the hood, unemployment rate ticking down, positive revisions. But what did you make of it?
Yeah, it really wasn't, anything but just confirming the trends we've seen. It was, at the headline level, a little weaker than expected, but, revisions were extremely strong. So that more than made up for it. Looking under the hood a little bit, of course, unemployment ticking down, labor force participation ticking up is a good sign. I think probably the highlight for me today was looking at the average hourly earnings. So month over month, you saw that go up about 0.5% compared to estimates, I believe, around 0.3. So that's a good sign. Look, we need the consumer to continue to have and show the strength in spending, and having money in their pockets to do that is exactly what we're looking for to help, continue to fuel the economy. But, it's that balancing that with the inflation side of things. And I think with some of the inflation survey data this morning as well, the net result is probably just less need for the Fed to cut rates. And as a result, you're seeing bonds down, rates up a little bit.
Yeah, Vishal, I want to bring you in on the rate side of the equation because, yes, rates are up today on, in particular, those inflation expectations as part of the consumer confidence report. But in general, we've seen rates trending lower, even with all of this talk about potential inflationary impacts from tariffs. So talk to me about what's going on there.
Yeah, sure. I think the market got ahead of itself. Probably, if you remember, like the third quarter of last year, where the market had completely priced in probably about 12 cuts by the end of 2025, which we thought was completely not justified at that point, given that the economy was not supposed to be resuscitated from a recession, if you will. But yes, we were coming into it with two very weak unemployment reports. Fed quickly cut 100 basis points, financial conditions eased, you got a Republican sweep, and then the market was overset up for the inauguration day, in our opinion. And that's where you saw that 475, 480 on the 10-year revert back around that 450 level. So we do think that this year is going to be a very range-bound, choppy, very volatile, but the range is going to be 4 to 5%. 4% is going to be difficult to breach for the 10-year because we don't think that the economy warrants or the health of the economy, and we saw it in the employment report today as well. The 3-month, 6-month numbers are back up again pretty nicely. So you got to really squint to find a recession in the economy. And on the 5% side, I think that is where we do think that the economy starts to get a little bit difficult in terms of the refinancing for whether it's regional banks, whether it's commercial real estate property in San Fran, in New York City. And that's why we think it's a very range-bound, but very strong from a bottom-up perspective for the fixed income as well as from an economy perspective.
Mike, bring you back in here. I would imagine if you were Jay Powell, Mike, you saw that jobs report and maybe gave you confidence that you made the right move and taking a pause here. If they continue to hold here, though, Mike, and they continue to sit on their hands, what does that mean for the market? How do you think the market would react to that?
Look, I, for one, would not be surprised at all to see, rate cuts continue to kind of come out of the market this year, at least expectations. Although, actually, I think at this point, it's more fair to see the rate cut come out of market expectations, as there really isn't much, in the cards for 2025 as it sits right now. But look, there's plenty of historical analogs for rates at these levels not being a problem at all. As long as we have a strong consumer, growing economy, good earnings, we have all of that. Not to mention, you've got the AI theme, which has potential huge productivity benefits. Of course, we've seen some volatility there recently, and maybe that's been bad for a few names that are priced for perfection. But by and large, cheaper AI is nothing but a productivity enhancer, positive for economic growth. And in that environment, rates at these levels is perfectly fine. So I think as long as we don't get a 10-year over 5%, which seems like a kind of a stretch at this point, we shouldn't really see any stress in equity markets. Just given the underlying economic data and the strength there.
So, Vishal, Mike, they're talking about the interplay as a potential risk to equities if we got the 10-year up again. What do you see as the biggest risk that you're watching in the bond market right now?
I think one of the very clear ones, and I know it is a little bit of a consensusly discussed one, is the deficits. And I think there was a first step towards that when we got the refunding announcement, when we got the new Treasury Secretary speak about the future plans there about issuance and the term premium. I think from our standpoint, and Mike touched on it as well, if consumer and corporate balance sheets are strong, which we have a high conviction in, we don't have to worry about the refinancing wave or refinancing wall that is showing up in some parts of that market. I think we feel pretty confident that will be we'll be able to tide over that. But the Treasury market refinancing wave is one that we are definitely nauseous about.
Mike, for viewers right now, we're looking for some ideas and opportunities. You like software and services, you like cloud computing. What don't you like, Mike? What would you avoid?
Right now, one of the things I would definitely avoid is kind of your classical value and classical defensive exposures. When you look kind of in the defensive space, you really need lower rates or really weak growth for that trade to work. I don't really see a strong catalyst for either one of those right now, given current conditions. So I think any allocation that you could have to defensive could be better put elsewhere. And then on the value side of things, while I do think, under the value umbrella, banks are a good place to be. They've been very strong, the deregulatory efforts there and where interest rates should be good for them. But some of the other popular sectors in those segments, like energy and materials, some industrials, these exposures that might be levered a little bit more to China exposure, I think are best to avoid. And, overall, take that capital. And I really like barbell portfolios right now. So still leaning into that software services side of the AI trade, but then also the broadening outside of things with small and mid-cap stocks. I think strategically, as a longer-term hold, this is just a great entry point for that, especially with the range-bound rates, that we're talking about here. Could be quite conducive for that trade to work as we see earnings start to broaden out, which we have started to see that, here through earnings season.
Mike, Vishal, great to see both you guys, and have a great weekend.
Thank you.
Thanks.